Hey everybody, it's Craig Moser. It is the 12th day of May 2020. Wanted to spend a little time with you and bring you up to date on what's happening in our stock and bond markets. So we'll just dig right in here. Um, Looking at what has happened over the past year, you can see it's sort of a interesting world that we're in. We are in a world that is shut down. Now it's starting to open back up, which means that, okay, what happened? So, when I compare this to what has happened in the past, one of the things that kind of sticks out to me is comparing this to 2008, 2009. It's a huge difference. First of all, in 2008, 2009, that massive market correction, the market, there was something dramatically wrong economically. Today, what we have is a global shutdown due to a pandemic from a virus. So business is ready to go if we can survive it and not get everybody sick and revert back to where we were before. So a lot of difference between then and now. As far as the world is concerned here, we're ready to get going. And so all we have to do is find a way to crank back up the economy. Now, what has happened, which is extremely similar to what's happened in the past, is that the massive infusion of cash and government, I'm going to say government intervention, has occurred. We created a lot of capital. We distributed a lot of capital to people. And so that creates a deficit, a big one, about $3.2 trillion deficit so far this year because of all the extra capital that we had to put into our economic system so that people would still be able to function at some degree until we found a solution to the coronavirus. So it's an interesting thing that has occurred. I don't know exactly what the outcomes will be. You would think, okay, we'll just get going again and everything will be fine. The issue is how much has it cost us and what will be the repercussions longer term. Shorter term, businesses will probably open back up. Shorter term, we will see some businesses fail. We will have to help some businesses. As far as what we're going to need to do longer term, I don't think anybody really knows because we really haven't done this type of thing before to the extent that we have done it this time. So let's just kind of dig in and look at what has happened. So what I have in front of you is a 5-year chart of the Standard & Poor's 500 index. You can see that we were here 5 years ago. We were there about a month and a half ago. Fascinating, because what we're seeing is a stock market that really lost 5 years of return. Now it has started to recover. So where would be a good set of reference points to look at? Let's look at, if we can, Craig's not a great navigator here today. Let's look right here and say, okay, if we look right here, this is sort of an inflection point right in here somewhere of where we are. So that is back to January 2018. So 2 years ago, that was a market top, and that's about, not exact, but about where we are today. So you go, huh, that means that we lost a couple of years, but hey, it came right back. If you look back in time and say, how did this work before? That happened as well. We had some rebounds and recoveries and things during that market decline as well. So I'm not saying that we're going to have a massive decline. I'm saying that this is by no means something that tells me, okay, we're just going to have the same rebound that we had in 2018. If you look back at 2018, we had a market that dropped, churned around, went back up here and peaked out right at the end of September 2018. And by the time we got to Christmas Eve, had dropped back, substantially. V bottom recovery. That's what they call this, a V bottom recovery. It occurred in 3 or 4 months, and we just happily went on our way and forgot about it. Why? Because it came back quickly enough to where it wasn't painful. If for those of you that can remember 2008 and 2009, we went from October of '07 all the way back, and it took about 495 days before that decline stopped. That doesn't mean it recovered before it stopped. And then it took until about April 2013 for us to recover back to where we were. So a long time, a long time. This one is different. All of them are different, but so far, markets seem to be forward thinking and are encouraged that we will be able to crank back up our economic system sometime, hopefully full bore, full sprint by maybe September, October of this year. So Q4, a lot of people are putting predictions out that we'll have some pretty strong recovery in Q4. I'm a fan. Let's get it going. I hope they can do it. I'm worried that we can't. Here's why. Coming to work today, now I live in a little community called Germantown, which is near Winston-Salem. Not a very big airport there, and there are parked several huge airliners. I mean, this is not a big airport. And a lot of my friends are telling me that you see those airplanes, hobbled, if you will, stopped on the side of the road, parked at airports. And so what's happening is those planes aren't flying because people aren't spending the money to go, and it's unsafe, or at least they see it as unsafe to go there. So, okay, that's a problem. Does that make economic sense to have a market recovery in that environment? Not really. So just understand all is not good, but there's a lot of optimism that we will recover back. So peak to trough, or from here to here, it depends on where you measure from, how we're doing from a market standpoint. For us, we use math, so we're not too worried about when we re-enter a stock market, but just understand, this has to continue moving in an upward trajectory for this to really work good long term. All right, let's look for a minute at our friends in Europe. So I'm going to use the iShares EFI index, Europe, Australia, and the Far East, and you can see a different looking chart there. So again, I'm looking back in the window 5 years, and what we're seeing here is a market that has yet to recover. So we had periods of downturn, periods of upturn. This was sort of the tariff period right there. We had mild recovery, and then, just as our market did, a massive drop. I mean, it's a drive off the side of the cliff drop. And now some recovery, but really this market, if you exclude us and the emerging markets, the sort of developed foreign markets are back where they were somewhere in the 2015, 2016 timeframe. Just not that great yet. If we look at emerging markets, let's see if I can remember all these symbols here. Emerging markets looks very similar to the other chart, Europe, and Australia, and the Far East. So what we're seeing is US has fared a little better. Is it a higher point? Does that mean we're stronger? I certainly hope so. Does that mean that we have more potential for economic growth? I certainly hope so, because we're going to need it with all the extra money that's been created out of thin air and interjected into our economic system. So anyway, you can see none of these markets have really given the type of recovery that the US has so far. Preface that, so far. All right, let's look at bond markets, because this is kind of interesting. I'm going to start with high yield bonds. HYG is what I'm using there. This is the iShares High Yield Corporate Bond ETF. I use it as my proxy for high yield bonds. When you look at that, you can see high yield bonds doing just fine, and then similar to the stock market, because these are high yield bonds, so they react similar to a stock market, and then a precipitous drop in these bonds. Now, these are not investment quality grade bonds. These are high yields. You know, they used to call them junk. I don't think they're junk, but they're not issued by, you know, IBM and Pfizer. Now, when we look at what happened on the rebound, you go, why did that rebound so heavily? The Federal Reserve Bank has basically backstopped these debts, meaning that they have said, we're going to make sure that bond markets remain liquid, bond markets remain fluid. So this is not an organic thing, this is a government backstop, because people are afraid that these folks will not be able to pay their debts. So the government has intervened, if you will, and made sure that they will. So high yield bonds, not so solid right now. But, you know, with the government backing, there is more confidence. That's why you saw this rebound back into this range. All right, when we look at high quality bonds, maybe a little bit more investment grade, you see the same thing happened right here. People were afraid companies wouldn't be able to repay their debts. And then that same recovery, but back up at a higher point. So investment grade, more high quality corporate bonds have seemed to do a little better. And then if you look at Treasuries, this is a 7 to 10 year U.S. Treasury bond ETF done by iShares. You can see that is where the vast majority of capital has flowed into the safest thing that they deem that they can buy, which is a U.S. Treasury. A lot of capital inflows. That's the reason why the price is high. Yields are screaming 1.66, you know, and you have to own that a year to get it. So just understand, Treasury bonds are not really a great deal. It's just a safe haven type of investment that people have flowed their money into. Other things to look at: gold, fascinating. The chart's very similar to this one. Gold, if I could type, gold has the same sort of chart pattern. It started moving up right in here. That was before COVID. That was back in late 2018, December, and has had a fairly significant move to the upside since really the first of 2019. So money has flowed into gold, and then when COVID-19 hit, it had another leg up. Pretty good. So will that continue to be an upside gainer? I don't think so, but I don't know anything about, you know, gold. Gold is a shiny gold metal. Doesn't earn anything, doesn't pay a dividend. So just understand that people see it as a currency alternative, a safe haven. Sort of like Bitcoin for the younger crowd, gold might be an investment for a little older group, me. All right, so we've looked at a lot of things here. Let's look at real estate for a minute. I'm going to use Fidelity's ETF, real estate, and you can see real estate was on a very nice upward trajectory and then has dropped a lot. So that is forward-looking investors saying, I wonder if people will continue to buy real estate. Will real estate continue to be a good investment? And so the world is swirling around this type of thing. You know, do I buy an office building where people will go to work? Do I buy a warehouse? Do I buy a retail establishment? Do I buy apartments? Those types of things. That's what composes this real estate index. And so the jury's out as to whether or not retail will work. The jury's out as to whether or not a lot of corporate offices will be, you know, revenue producing and growing out in the future. So we'll just have to see. This is a different metric, what has happened here. So just be aware that all is not great, but it's certainly better than it was when we were talking about this in mid to late March, which was right down in here at the bottom of this drop. It's been a big peak to trough, upside and downside. When you look at what's happening, this is kind of a true chart for any of it. You've got big upside, and then you've got, you know, just as big downside. So these wide variances in returns over short periods of time really is where you've got to ask yourself, do we have any idea what's going to happen? Up 31, down 20, 28 in the real estate. This variance between these two is total indecision. People don't know exactly what's going to happen. So just stay tuned, stay safe. Here's the things that I think you should do from how we're managing money today. We're erring to the side of safe. We're not going to try to pick a market bottom. We're not going to try to participate in speculation that the markets may return or may not. We're in a neutral pattern using a lot of treasury-based investments, things that have limited but good upside, things that will be safe if we see another downturn in the near future. Have no problem moving back into more aggressive investments. Mathematically, we have not been told to do that yet. So we use more of a math approach. We're more concerned about not achieving these maximum drawdowns, and we're working hard to make sure that, you know, we have a more steady outcome in our investment management versus, you know, volatility and the exciting part, but also the terrifying part. So with that said, what I'm going to do is call it a meeting. Don't want to talk too long. And if you have any questions, as always, give us a call. Our number is 336-448-1086. And with that, I'll bid you a good month.